Okay, we are here.
Hi, and you are? Sorry, I can see the.
Okay, Boniface Yemba.
Yeah, I think we're missing Julius, the first paper. Julius, are you there? Or any of his co-authors? I guess not. Okay, so the second paper. Is Evans here?
Yes, Evans is here. I can.
Yeah, I'm here.
So we are going. If Julius is not here, by the way, hi. How is everybody doing under the circumstances?
Yeah, great.
We are doing well.
Okay. So since
Just
Julius,
No, just a quick one. I think the cloud sent an update that paper was withdrawn. So as new one is sent, ours is the first paper. We have 4 papers now.
well, this is good. Yeah, this way everybody gets 15 minutes. So
and my co-author will be presenting Dr. Adeleye, the second author on the list. We can be discussing the paper.
okay, Dr. Adeleye will be presenting.
She's presenting Ngozi Adeleye. She's right in there.
Are you going to be presenting?
I'll be presenting for the team.
Yes.
I'll be presenting for the team.
Yes.
You know.
Yes, you're going to be presenting, but are you going to be presenting now? Do you want to go first?
Yes, what I said
exactly,
earlier.
I'm ready.
This is the first paper, yes.
Okay, so let's her do that. I think I'm going to skip the introductions. My name is Mina Baliamuni. You can see everything on the program. And we're going to start with the first paper. I have internet challenges or problems, and I think if I disappear, I would like you, Evans, if you could share. If I disappear, but if it works, it works. So what we're going to do is that everyone will get 15 minutes. I prefer that we do the papers, all of them first, and then we do this discussants. Is everybody here for discussing? I suppose, I hope. Okay, then we'll do the papers first. Everybody gets 15 minutes. That will take 1 hour. And then when we go to the discussants should get 5 minutes each, and then we'll open it to general discussion. So go ahead, please, start. I'm gonna close my camera.
All right, thank you, Mina.
You're welcome.
Thank you, Mina. Thank you, everyone. I'll be sharing my screen now. Please, can you all see my screen?
Yes, please.
Yes, we can.
Yes.
Okay. All right. I'll say Happy New Year to everyone. We are delighted to be part of this historic AFIA ASA 2021 International Conference. And I'll be presenting a paper titled The Criticality of Regional Economic Integration and Services Trade in Africa. Evidence from COMESA and SADC countries. My name is Ngozi Adeleye, and I'll be presenting on behalf of my co-authors, whose names are shown on the screen. The outline of the presentation goes thus. I'll go through the introduction, objectives, the framework, the model and technique we applied, our findings, conclusion, and policy recommendations. The introduction. Services trade is important for growth, development, according to Eisenberg 2011 and Oakman 2017. However, Eisenberg 2011 argues that services trade is yet an integration arrangements. This is due to Africa's low attention to services trade in spite of its inclusion under the WTO GATS Article 5. UNCTAD 2016 also noted that in terms of agreements between African countries and other third parties, all African member countries of the WTO accepted GATT's commitments, as well as those that are negotiating their accession to WTO agreements. In addition, some countries have signed or are negotiating trade agreements, which include services liberalization at bilateral level, such as the US Trade and Investment Agreements and the Economic Partnership Agreements with the EU under the ACP-EU Cotonou Agreement. For instance, SADC members signed a protocol on services trade in 2012, which is largely modeled on GATT's, providing for gradual liberalization of services trade in different rounds of negotiations. For services trade to be fully operational, some barriers which need to be addressed are as follows, but are not limited to those shown on the screen. For instance, quotas, local content and prohibition of foreign access to service markets, which are reserved for domestic suppliers such as nationality, residency of visa requirements, entry and exit taxes, and of visa fees for movements of natural persons. Others include licensing fees, tariffs on goods related to provision of services, price controls, discriminatory access to information channels and distribution networks, for example, in telecom, air transport, and tourism. Granting of subsidies, which have a trade distortive impact on export from other countries. And lastly, the lack of transparency in government procedures and technical standards and licensing procedures. The objectives of the study is to empirically examine the level of services trade and regional integration, how regional integration can influence services trade in COMESA and SADC member states, and also to understand or evaluate the degree of regional economic integration in COMESA and SADC member countries. The framework we deployed is built on the outward-oriented growth theory. This theory is a strategy which proposes an export-oriented promotion approach to the industrialization process and growth of an economy. The hypothesis posits import substitution as a means to encourage domestic production and boost exportation, which ensures competitive output. The World Bank 1987 advocated the outward-oriented growth strategy, given the resurgence in growth of economies that adopted its use. The theory sprang up amidst the then ongoing debates on the most effective development strategies to be adopted by countries. Our empirical model, as shown on the screen, we used a baseline log linear model which specified the different categories of services trade as a function of the indicators of regional integration and other control variables. So I will only zero in on the dependent variable and the key regressors. For the dependent variables, we have the different categories of services trade, which are services trade as a whole, and also the commercial service exports. And to check for the robustness of our results, we deployed the mode 2 travel, import, and export variables, which are the indicators of regional integration. We used the Mobility Score Passport Index sourced from World Openness Score and the Visa Openness Index obtained from the African Development Bank. These indicators showcase both the opportunities and mobility as they indicate the ease of travel by taking into account all visa waivers. On the screen are the different features of these two integration indicators. Ranks passports based on mobility score. It also measures people's current or potential number of countries that can be visited visa-free, up to using 4 passports. And the higher the mobility score, the better the passport is ranked. The highest score is 1. For visa openness, it captures the degree of openness of countries or travelers in terms of the need for a visa, the type of visa, visa facilitation, and the ease of visa processes. A country score ranges between 0 and 1. A no visa requirement scores 1, and the visa required status is represented by 0. So this implies that countries should opt to have a high degree of visa openness index for regional integration. The analytical approach is to investigate comparatively how the regional integration fosters services trade in Africa, but using COMESA and SADC as case countries, as case studies. Our estimation technique is using the pooled ordinary least squares method, which captures variation both through time and space. Some of the results we obtained, beginning with the stylized facts showing the trade positions between SADC and COMESA countries. What we did was to divide the sample into two and do a comparative analysis of 2000 to 2007 and compare to 2008 to 2017. If we look at the first period, we can see that COMESA countries ended up to be net exporters, given period 2000-2007. Net exporters in the sense that the volume of exports outweigh the volume of imports, leaving a positive trade balance. Compared to SADC, SADC ended this particular part of the year, 2000-2007, as being net importers, given the fact that the volume of imports outweigh the volume of exports, given a negative trade balance. Looking at the comparative year of 2008 to 2017, both regional economic communities ended up to be net importers, as both imports outweigh their export components. On the visa openness index, we can also see that comparatively, on average, countries in COMESA seem to be more open than countries in SADC. I think I need to point out here that the visa openness index is only available for 3 years. So we can only make analysis across this 3-year period. And given that, we can see that on average, COMESA countries seem to be more open than countries located within the SADC regional economic community. On the mobility score, what we have on the screen is towards your left is a global ranking, and to the right is how African countries are fared within their domain in comparativeness to the rest of the world. Looking at the global ranking, we can see that countries located within North America are ranked highest on the mobility score, and we can see that their rank is 4.3, followed by countries located in Europe and Central Asia with 130.877, ranked 23.5, and countries located within the Latin American and Caribbean countries, their mobility score is 113.5, ranked 34. Sub-Saharan Africa on this list of ranking is ranked number 6 with a mobility score of 59.114. So we can see that compared to the global world, Africa is actually less open. Looking at within Africa's regional economic communities, COMESA seems to have a better mobility score than the rest of African countries. Oh, let me say that again. SADC countries has the best mobility score of some 7.133 and ranks 56.68, compared to COMESA at 52, ECAS at 50, and ECOWAS at 56. But overall, we can also see that each of these 3 countries actually rank below the rest of the world at 108.24. Our empirical findings are shown on the screen. Looking at visa openness and services trade, we can see here that SADC countries shows to have the largest elasticity of 2.209 compared to COMESA countries. I'm only going to restrict explanation to services trade. So we can see that SADC countries show a stronger elasticity at a very high significance level of 1% compared to COMESA countries with a very low elasticity of 0.35 and a weak positive significance, even though both coefficients are positive. But SADC countries show to have stronger significance than COMESA countries. Looking at mobility score and services trade, both regional economic communities have positive coefficients, but again, SADC countries shows to have a larger elasticity and stronger significance level relative to countries located in COMESA, which shows to have very low elasticity, though a good significance level at the 5%. Our conclusion. The study finds that from the stylized facts, COMESA has a relatively higher degree of integration, which on average is 0.48, that is using the visa openness index that SADC countries who on average are having 0.39. This implies that using the VOI, COMESA ranks higher than SADC on the degree of integration. However, empirically, SADC countries has higher VOI elasticity, which is able to trigger services trade relative to COMESA member countries. In addition, for services trade, COMESA and SADC have positive and significant coefficients with respect to mobility score. Again, the elasticity is smaller for COMESA countries relative to SADC countries. Overall, these outcomes underscore that efforts to promote mobility or integration across Africa's regs by removing associated impediments will enhance the performance of services trade. Our recommendations. The significant outcomes are necessary to ignite new policy debates on rethinking and fostering free trade and free movements agenda among African countries. The repositioning of trade agreements that encapsulate services trade should address supporting key infrastructures. Hence, cooperation among members of a given regional economic community and across regs in terms of infrastructural development and building stronger institutional framework are essential to boosting services trade. Thank you all for listening.
Excellent job. And you kept it, actually, you still have like 1 minute. We are going to move on to the next paper. Is Hanan here? Hanan or Iman?
Hello, yes.
Iman.
Hi.
Okay, so Iman is going to be presenting the mispricing of sovereign risk and inherent behavior in African debt markets. Oh, that's, yeah, okay. So go ahead, I'm gonna shut off my camera and my mic. How are you doing? Are you in Abidjan? Are you in Abidjan?
Yes.
Okay.
Yes, hi, how are you? Okay. Hello, everyone. Happy New Year. Today, I will be presenting a joint paper with Iman, which is on the issue of mispricing sovereign risk and herding behavior in debt markets. So in terms of the motivation for this paper, it's really driven by what we've been seeing in Africa debt landscape, which has been changing rapidly over the last decade. We have seen increase in external debt issuance and tapping of the international capital markets. And this has been in part driven with the lower global interest rates, allowing governments to borrow from wide range of sources to finance investment, infrastructure and investments, as well as development needs. However, assessments by investors and creditors of Africa sovereign assets have worsened, despite what we have seen in terms of improvements in countries' real macroeconomic indicators. Actually, African governments still pay a 2.9% percentage point premium to issue sovereign bonds. And these are valuable resources that could instead be used for development. Also, the cost of insurance against defaults, which is CDS, has increased. At the same time, most of the literature, existing literature on sovereign risk pricing is really drawn from developed and emerging economies, whereas evidence from developing countries, particularly Africa, remains scarce. So this paper fills the gap in the literature. In terms of the research questions that we are looking at, we're trying to look first into if there's evidence of contagion and herding behavior by international investors in Africa's debt markets, and whether there's a tendency to treat Africa as one asset category. We're then trying to also understand the nature of the drivers of mispricing of Africa's debt and the role of herding behavior in that. And to what extent basically does the herding behavior explain this mispricing of Africa's sovereign risk? So moving to the methodology of what we're trying to do. So the paper starts first by using the modified cross-sectional absolute deviation method, which was used by Chiang and Zhang 2010, and augmented by adding return dispersion of other regions and squared return of that market in the region or country. So here you have the modified the SAD, the cross-sectional absolute deviation at time t. And basically you have that regressed on the squared return from other region. And basically, so for M here, that would be for the rest of the African group for a certain relative to a certain country, and then you will have the squared of that term, which basically measures the absolute deviation and the measures the squared average bond yield in other regions. So the other regions here, this is the RM2 for other regions of the world. And that really measures these squared average bond yield in other regions, such as Latin America, Asia, developed Europe, developing Europe, and other developed. And here in this specification, what we are looking for is basically for the coefficient of the third term, the R squared M, it captures the dispersion relative to returns, and you know, in the literature, this term basically having lower dispersion and nonlinear relationship between the dispersion and market return implies herding. So we will be looking at the significance of that term and its sign, as well as for the significance of the coefficient of the third term, fifth term, and its significance basically telling us the relationship to what is happening in other regions and the spillovers across regions. So in the second part of the second part of the methodology that we are using looks at basically the drivers of the sovereign spreads. And here we follow the literature in terms of extending the sovereign risk pricing framework to estimate a standard panel regression with country fixed effects, and basically to regress the, here we will talk about, like, you know, the variables that we, detailed variables that we will use in all estimations soon, but basically we use a couple of variables to capture the sovereign risk. One is the CDS, and the other one is the bond yield. And this is regressed on macroeconomic fundamentals, and we'll go in detail soon into which variables were used. And also as well as country fixed effects. Here we have the RJ, which is basically the regional price of sovereign risk for the region in which this country is located, excluding the country itself. Then after that, what we do is basically to do a decomposition, Oaxaca decomposition, to try to disentangle basically the role of herding in explaining the differences between the pricing for Africa, sovereign risk versus for other regions. And basically the Oaxaca decomposition will allow us to do that, to look into basically how that kind of like the Africa premia is explained in terms of whether it's explained by endowment versus other factors that are unexplained. Then, in terms of the data that is used, we use, as I mentioned, two separate financial prices of sovereign debt risk, the monthly closing prices of sovereign CDS spreads, and the government bond yield spreads. Our sample size is 55 countries, 17 African countries, 6 Latin American countries, 8 Asian countries, and 15 developed European countries, 5 developing European, and 4 other developed countries. The selected countries were really determined by the data availability for the duration we're looking at. And the macroeconomic data was collected from the WDI, IMF, and IFS. So moving to the results. So here, basically, what we see is based on the first part of the methodology that we talked about. It shows the spillovers between across regions and the role for herding. So here we talked before about how the coefficient of the third variable will be important to show the evidence of herding. And here we see that that term is actually negative and significant across all regions, and particularly for Africa. We also see for the CDS spread evidence of spillover and contagion from all emerging and developing regions to Africa for CDS spread. So for CDS, it seems to be that whenever there is events or issues affecting the CDS markets in developing and emerging markets, it has a significant impact on Africa. Interestingly, and of course, this is like, it also relates to the issue that for CDS market, it's related also to the countries that tend to be in the same risk group as the continent is. So in that sense, it makes a lot of sense to actually be affected by regions that are in similar level of development and credit risk. Then looking at the same results for bond yield, we see also that this coefficient for the RM squared is also negative and significant for all regions. However, here we see that the impact of contagion and spillover from all other regions of the world. So it's not only from developing and emerging countries, but from all regions around the world. which really highlights the exposure of Africa to changes in sentiment and global events and the regional developments elsewhere. Okay, now moving to the issue of examining the drivers of the sovereign risk. So here, basically, as we talked before, we have look at the CDS spreads regressed on number of macroeconomic fundamentals, including GDP growth, real per capita GDP in logs, government debt to GDP, current account to GDP, fiscal balance, inflation, reserves, and a proxy of the global conditions and sentiment in the market, which is measured by VIX. And we look at this across different regions. And this table here shows that basically there is a strong role for fundamentals, but also there is a role that we see also for impact of sentiment. So we see like all the results are intuitive and robust from both the perspective of signs and significance. And the empirical evidence shows a link between the fundamentals, such as things like GDP growth and a better current account position, fiscal better fiscal performance, and stronger reserves, really lowering the spreads for the concerned country, whereas things like higher government debt and higher inflation having a negative impact on the spreads. And we see that actually seeing higher volatility in global markets measured by VIX actually leads to higher spreads, CDS spreads. So these are kind of like, you know, the direction of intuitive results that we would expect, and it's in line, you know, with what one would see, but it shows also not only the important role for fundamentals, but also a role for sentiment in affecting the spreads. Now moving to the same exercise of examining the role of fundamentals versus sentiment and the driving the bond market spreads, and we see similar also results in terms of impact of fundamentals driving these levels of bond spreads. However, we see a smaller role of the global market sentiment impacting, at least for Africa, the bond yield, monthly bond yield behavior. However, we see also the RJ term here reflects the change in sentiment as Africa come into or fall out of favor. So RJ here being significant is suggesting higher sovereign risk, that there has been regional spillover of sovereign risk in Africa. Okay, now moving to the Oaxaca decomposition to try to really disentangle the sovereign debt pricing differential decomposed into three parts. Sorry?
That means this alarm means the 15 minutes are up. But
Okay.
go ahead for another minute, so if you could just get to the conclusion.
Sure. So basically what we see here is that reflecting the effect of the regional differences in endowment coefficients and the simultaneous effect of pricing gap between Africa and non-Africa, we see basically that the results show that this pricing differential is explained by both endowment as well as by the coefficients. So what it shows is that there is a role, there seems to be a role for herding behavior, a significant role for herding behavior in explaining the differential, that it's not really fully explained by the difference in fundamentals. Given the time, I think, I mean, here, very similar results to what we've seen, what we've talked about in terms of the impact. I think the important things here is the role that there is a very important role for the level of government debt and the level of fiscal balance in influencing the differential. And finally, maybe let me just conclude that what we find in the paper is that there is evidence of herding behavior in Africa debt market and asymmetric investor behavior. And this really has implications for the continent, that investors tend to treat Africa debt as one asset class. And basically may not be that the market sentiment is not always related to macroeconomic fundamentals. And therefore, this can be it's a very important issue for governments and policymakers to take into account the need for further prudence, because Africa tends to be more exposed to changes in sentiment, and which leads to also higher mispricing relative to other regions. So I'll stop here. Thank you very much.
Thank you. And we continue with this, going to the third paper, and I think Boniface is here, right? You're going to be presenting?
Yes. Boniface, can you share your screen, please, Boniface?
Thank you.
Eric, should you start the first part? Then Eric.
Yeah, I'm starting, but Boniface gonna share the screen.
Yeah. Hey, Boniface, can you unmute yourself?
Okay.
Okay, can you go back to the beginning, please? Good. Go back. First slide. Thank you. The first one, please. Oh, okay. Good morning, everybody. So my name is Eric Itenge. I'm going to be presenting the first part, and then my cohort Boniface and Bian will come after. So this paper is about the quantitative impact of African continent free trade area on African economies. So we're gonna start by giving you guys like the background. So we know that the volume of trade has been increasing over time. However, it seems that the share of intra-regional African trade has remained low, below 10%. It's about like 7 to 8%, depending on the data set that you're using. So in response to that, there are a lot of initiatives that have been taken to boost that trade. For example, there is the implementation of the African Continent Free Trade Area that is supposed to boost trade between African countries. So what we are going to be doing in here is we are trying to quantify potential gains from the AFCFTA, while accounting for some realities of African economies, given that they depend more on non-African countries. Boniface, next. So if you look at the literature, you see that starting with Eaton and Cotton in 2002, he developed a model and to try to quantify the impact of trade agreement. However, if you pay attention or look at the literature, you will realize that there is no consensus up to now. There are some researchers who have been able to reveal positive impact of trade agreements, but we also have some other researchers who could not confirm such positive impact. But we also have some other papers that tend to say that the impact depends. We have Caliendo and Pero here. They found that the NAFTA trade agreement has positive impact on the US and Mexico, but negative on Canada. Next. Then we also have another strand of literature trying to depict drivers of trade agreement impact. So some of the drivers that have been identified so far are physical infrastructure or production structure and regulatory reforms. We also have the regulations of businesses, financial development, better educations, the rule of law and flexibility in labor market. However, we could not come across a paper analyzing the impact of lower interconnection between African economies and potential gains of the AFCFTA. So as I told you, the volume of trade between only African countries is like less than 10%. So we want to see what could be the implication or the influence of that one on potential gain. Boniface, good. So what we are doing in this paper is we are using a 3-country DSG model that account for African household particularity and then structures of African economies. So we're gonna be using 2 African countries and the rest of the world. That is representative of big trading partners of African countries such as China, India, European Union, and the US. Our setting will maintain the tariff on goods from the rest of the world. And also another innovative thing that we're doing in here is we are measuring output by value added and total product approach. So now I'm gonna give the floor to, let me talk about, kind of summarize the result, and then I'll give the floor to Boniface. So our results are depending on the measure of output that we're using. One of the main findings is in short run, we find that following elimination of tariffs, there is an increase in output, there is an amelioration in terms of trade, consumption goes up, trade increases, there is appreciation of currencies, and the value of trade liberalization, but the value of trade liberalization is small. However, most of the impact here tends to vanish quickly, except for the appreciation of currency in the member countries. Boniface, can you talk about the model, please?
Okay, so thank you, Eric. As Eric mentioned, we use the 3-country model. And in our model, what in the most feature is that we have we use 2 countries, African countries, which have signed the Africa Agreement and ratify it. And when we are working, so now they have 34 countries, but when we are working on the paper, it was just 29 countries. And we're gonna use home and foreign and the rest of the world block. And we have 3 types of goods. We have traded goods, natural goods, and natural resources goods. And we have 4 main economic agents. We have the government, the producer household. In household, we have 2 types of household. The Ricardian who participate in financial markets, and the non-Ricardian household, they just work and it's just by budget constraint. That is most African, household. And each household try to maximize the lifetime utility function. That depends on private consumption, real money balance, and labor. This is the for Ricardian household, because they are allowed to be entrepreneurs and workers, and no accountable just workers. So this is the budget constraint for Ricardian, and on the bottom one, it will be the budget constraint for non-Ricardian. So this is the, we model in the sense that the subgroup K represent home or foreign African countries, and W represent rest of the world. So the consumption, aggregation of the consumption depends on not traded goods produced in Africa and traded goods. And so because the traded good consumption bundle, so we're gonna try to impose tariff on that, because the traded good depends on import goods from intermediate goods, because this is represented by manufactured goods for consumption. So we import from rest of the world and some from other African countries. So it's the same thing for, we have the same utility function, production function for both traded goods and not traded goods. But the third sector, that is natural resource sector, is more, they don't use labor over there. They just accumulate, they just use to produce. So we have the land, which have, the mining or oil. And also we have foreign direct investment from the rest of the world. And we have intermediate goods, from the rest of the world. That, and we have an equilibrium, what we have here. So, but the most driver of the trade is that the tariff on import goods. So the government will have lump sum tax, and then we're gonna collect the tariff revenue from all the goods imported from the rest of the world, because we maintain zero tariff on 29 African countries. So the rest of the world bloc consists of a budget constraint from the represented household, the main function for domestic and imported goods, a production function just use labor capital, and domestic intermediate goods, and imported intermediate goods from Africa countries. And they have also a Taylor whole-time monetary policy, a new Keynesian flip curve. This is our calibration. We use data from 1961 to 2018 for those African countries. And most of the parameters, they are consistent with some literature in Africa, especially from South Africa and Nigeria and Uganda. This is our result. As you can see, the most important, the trade liberalization value, that what we measure in terms of welfare. The welfare here is measured by utility function, the second approximation of utility function. So we use SIM 2002 algorithm. So that one, we have one part is mean and the other part is variance. So what we are trying to do here is to define that variables, is that we have a situation with tariff and another situation without tariff. So for two cases, so without tariff, so that would be representing by the trade liberation. So we don't have tariff. So what is the consumption, a change in terms of percentages from the initial situation with tariff? That we're gonna measure as value of trade. As you can see, we have here, the star represent added value, and the circle represent total product. As you can see, the result depends on the measure of output. If we measure output in terms of added values, you can see that in tape liberation, there is a delay on impact. You're going to say negative, and then it will be positive, but the positive side will just last for 5 quarters. That for domestic countries. For the foreign countries, you can see that it's negative, and the value after 15 quarters, it becomes little positive. But when we look at total value, so total product, and as you can see that the total product here depends on the difference between the production and all the import process, the intermediate good process. So the total good process mainly are imported from the rest of the world. So without intermediate good, we can just look at the total value. You can see the impact, the variation for foreign country will be larger, positive, up to 15 quarters. But for the domestic country, that one is almost nil. And in terms of output, it's consistent with the literature. And you can see, depending on added value or total product, we still have different impact of trade on the value. So that I pass to Bia to conclude.
Okay, so our finding is that in the short run, following the elimination of the tariffs, as we previous slide shows, the outputs will increase, terms of trade become better, consumption of the household also increased, and the trade volume increase, and there's appreciation of the currency. And then the value of the trade liberation is actually small. And also most of the impacts vanish, mostly around 15th quarter. But you reach the peak at the 5th quarter. So around after 4 years, the positive impacts will vanish, which means it does not last long. And then there's some recommendation for the policy suggestions. So like the previous literature shows, if we want this openness of trade to improve the growth and the productivity within the African countries, there should be some complementary reforms to be undertaken. For example, we need to making the infrastructure stronger, and we should also boost the education investments and the basic, the financial markets need to be stronger, and then most important, very strong government is needed. And the last one is we have to promote the African capital ownership in the natural resource sector. And there's a similar thing has been done in China. As we know, before 1978, China was kind of closed to the international trade. After the 1978, China started to open to the economy, open to the world, and start to trade with the rest of the world. But China did a bunch of other complementary reforms. The first one was to make sure the most important, like natural resource sector, has to be controlled by the Chinese company. So it means the foreign investment, foreign capitals can invest in the natural resource, but has to be majorly owned by the Chinese sectors. So that's our paper. Thanks for listening.
Good. It's actually exactly on time. Okay, so thank you for this presentation, and we are going to go to our 4th paper, which is the effects of mining on health with evidence from the copper industry or copper mining in Zambia. And the paper will be presented by Chamba Kalonga. I hope I pronounced your name correctly. Hello, is Chamba here?
Yes, I'm here. Can you hear me?
Okay, now we can.
I'm just trying to share my paper. Sorry, I'm just trying to share my paper.
You may want to increase the volume a little bit up.
Can you hear me now?
Okay.
Can you hear me now? Is it much better?
Yeah,
better.
now it's much better. Yes.
All right. Okay, let me just try to share my screen. Sorry. Okay. Can you see my slides?
Yes, we can.
Okay. So my paper is entitled The Effects of Mining on Health. And in this paper, I'm going to provide evidence from copper mining, particularly in Zambia. The structure of the presentation is as follows. I'll first of all provide an introduction, which is just going to basically look at the major questions that this paper focuses on. I'll try to go back and look at the motivation that led to this paper being written, and also look at the literature that shaped this paper. I'll try to also focus on the contributions that this paper makes to the existing literature and to any further literature. Then I'll look at the data and the variables that were used to present this paper. And finally, the identification strategy and the results are going to be presented. Then I'm going to end with a conclusion, which is just going to be basically a summary of what the paper was all about and provide any recommendations that may be for future use by policymakers. So one of the major questions that will probably shape the introduction of this paper is the fact that many nations, I think, have focused mostly on the natural resource curse. And the natural resource curse encompasses a number of aspects. But in this paper, we'll try to focus on probably the economic impact on local communities living or surrounding the mines. And particularly one aspect that shapes the economic aspect is the health of people, because we know that a healthy population is more productive. So that actually has a link to the economic aspects of any nation. So is the presence probably of natural resources a divine blessing mostly to developing countries, or is it going to be a curse? And therefore, should countries that are endowed with natural resources anticipate maybe prosperous times that are going to be very, very productive, or are they going to fear an increase in poor health outcomes as a result of externalities such as pollution, which are very, very negative to the economic aspect of any nation? In this particular instance, I'm going to focus on copper production in Zambia, which is, I think, one of the leading copper producers in the world. Currently, I think it stands at 7th as the largest producer of copper in the world. And how does this copper production affect health outcomes? This comes from the background that there's been an increase or a boom in the copper production in Zambia as a result of foreign investors having to come in and invest in the new ventures, mining ventures, and the already existing mining ventures. So how does it actually affect the health outcomes of local communities? Are they impacted negatively, or is there a way that this is being cushioned off? Because we know that sometimes you can actually have a trade-off between wealth and health. So the more productive you are, is it going to be a negative externality on the health outcomes of local communities, or they're going to benefit in one way or the other more substantially than the loss that they actually make in the health outcomes? And one of the key questions is the causal impact of the natural resource booms resulting from any exogenous shocks that actually happen in the international markets. We know that most natural resources are sold at international markets, and these prices that are placed on these products are actually set by international markets. So there's an exogenous impact that actually happens because the nations that are selling these natural resources, particularly the mining products, do not determine the prices of these mining products. So these are the major questions we're going to focus on in this paper. So what is the motivating factor behind this paper? Like I mentioned in the introduction, there is what you call an exogenous shock, that is an external shock that comes in from the international prices of natural resources, and copper is no exception. copper prices are actually set by the London Metal Exchange. And as such, the nations that are selling this copper or any other minerals do not really have a role in what the price is going to be like. So do these exogenous shocks actually impact on health outcomes in the producing countries? And in this paper, I conducted quasi-experimental evidence. And this quasi-experimental evidence looks at the volatile prices that are in the market for copper, and how these actually lead to an increase in copper production, and ultimately how this increase in copper production is going to lead to probably poor health outcomes in areas or communities surrounding the mining ventures. And these communities are particularly called constituencies in the case of Zambia. So I'm going to look at those constituencies or areas or local communities that are close to the mines and how these are going to be or likely affected by the increase in this copper production. Like I mentioned, there is a possibility of reverse causality that has been identified in past literature between natural resource extraction and health outcomes, and also other economic outcomes. So this paper was motivated by this reverse causality that is actually happening in the literature that has been identified for this paper. Then lastly, there's an aspect of a possible endogeneity of natural resource extraction, meaning that there is some source of bias that may actually take place in estimating how natural resources actually affect the health outcomes of any communities or any economic activities. The literature that shapes this paper is mainly the cross-country evidence that has been identified by Sachs and Warner's research. Most of Sachs and Warner's research has focused on cross-country studies, but it's been identified that these cross-country studies do not most of the time take into consideration the cultural diversity that is found in different countries. It does not also take into consideration things like institutional factors. We know that behind, I think, most natural resources, especially in developing countries, that aspects of things like corruption that actually take place behind the scenes. And there are also other aspects that may shape different country setups. As a result, cross-country evidence may not provide actual evidence that is closely linked to the local communities. And as a result, I move further and look at one very important paper that shaped the thinking of this paper, which is a paper by Aragon and Rood on pollution and agricultural productivity around the mining areas in Ghana. And Aragon and Rood actually found that there is probably some relationship that actually exists between the increase in mining activities in a developing country setting and agricultural activity. The other paper that tried to shape this writing is the paper by Asel Gomez et al. In 2016 that looked at the trade-off between wealth and health. And this is a very, very important aspect when you look at the economic implications or economic impacts of mining or any nature resource production. Other papers that I tried to look at are Chube et al. In 2012, who wrote on the relationship between copper mining in the Zambian economy, and the focus in this case was on air pollution. And as a result, I tried to extend these studies and try to look at not just air pollution, but also things like water pollution, which is very, very important because it leads to some poor health outcomes, as has been noted from previous literature. So what are the major contributions that this paper actually makes to the existing literature? First of all, it provided detailed analysis on the mechanisms of the impact of nature resources on the health outcomes of local economies within a single country. And this is very, very important, like I alluded to previously, that the cultural implications, institutional factors, and other aspects may actually be very, very important in determining the detailed mechanisms of how natural resources impact local economies. It's important to be carried on in a single country setting or within one single country because it tends to provide particular policy recommendations that may be very, very important for a single country and may also provide examples for other countries that may be faced in similar situations. The other aspect is that in this paper, we try to establish how natural resources actually causally impact health outcomes in local economies. And this causal examination is as a result of the increase in activities that we actually notice in the copper production in Zambia. So we noticed that when there's an increase probably in copper production, there's a likelihood that there may be poor health because of an increase in pollution, but at the same time, the poor health outcomes may also impact on the production of the natural resource, because if you've got a poor population, the productivity tends to sort of like dwindle or go down and might be lower than what it could have been had there not been any externalities. I also contribute to the growing literature on that examines the impact of natural resources on local economies at a sub-national level, because I try to focus on a smaller unit. In other places, they call them municipalities or states, but in Zambia, they're actually called constituencies, which comprise maybe a smaller population than what could be looked at probably at a national level. Lastly, I use a novel data set. This is a data set that was actually drawn up from different sources of information. These include the statistical office, include the government itself, and West Metal, which provided data for the international copper prices. And this as such contributes to empirical studies on the impact of mining on health outcomes in a developing country setting, and also tries to resolve any endogeneity issues that may actually exist of natural resource extraction. The data that was used in this study is a household survey data from the living conditions and monitoring surveys. These were taken from 5 waves of studies, that is from 1996, 98, 2004, 2006, and 2010. These were particularly used because of the availability of the data. So the data that comes from the Central Statistical Office in Zambia is only available for this particular waves, and this is the reason why I use this data. And this data is aggregated at constituency level, meaning that I collapse the data to aggregate it at constituency level so that it focuses on constituency data and how the increase in copper production was going to affect each level of constituency of the local economies. In terms of copper production and copper prices, the data was taken from the mining company's annual reports, from the Ministry of Mines, which is a government ministry, and West Metal, as well as the central bank, which is the Bank of Zambia. And some of the data was actually collaborated with data from the World Bank. The main outcome variable in this case are the health outcomes, which are broken down in 4 different categories, because I picked the 4 main diseases that are directly related to the production of copper in Zambia. I use copper production in this case as a proxy for pollution because of the non-availability of data on the pollution levels in Zambia. The other control variables that come into play, and these include things like the constituency characteristics, which are the population density, the average age of the head of household at constituency level, the household size. Government expenditure is also used because it's also very, very important, because unlike other countries where constituencies will collect revenue from the mining industries and invest the money into the particular constituencies, in the case of Zambia, this is collected in a pool of a government revenue or treasury, and this is later distributed. But this is not distributed according to the levels of production, but it's distributed equally in each and every constituency, regardless of whether they have any copper production or not. The other control variables include things like access to clean water and how many households are actually headed by females. I also take into consideration the aspects of distance, the nearest mine, and this tends to take care of or account for any heterogeneous effects of distance that may occur in the study. So I grouped the constituencies into 2 categories. One category are those constituencies that are located very close to the mines and those that are located far away from the mines. And this helps to determine how the impact is going to be as you move away from the mines or as you get closer to any mining activity. The distance from constituencies to the nearest mine ranges from 1 to 912 kilometers, but I particularly picked a distance of 200 kilometers to separate the constituencies close to the mines and those far away from the mines, because the 200 meters radius takes into consideration how far the pollution effects are going to be, whether it's going to be air pollution or water pollution. The levels of pollution in this case are likely to change because of the increase in the copper production. There had actually been a copper boom in Zambia from 2003 because there was reopening of some extra mines from that time, and investment into other new mines began taking place from 2003. That is, I think, towards the end of the privatization of the mines. So we tried to look at how the copper production has evolved over time. So this is how the copper production has evolved from, I think probably you can pick from 1992 to about 2013, and we can see that increase actually taking place from around, I think, 2000 going onwards up to 2010. We can see an increase in copper production that is in metric tons per year. In terms of the estimation, like I mentioned, the dependent variables are the health outcomes, and these health outcomes take into consideration aspects like general sickness, that is how people would actually get sick generally, that is any general illness like a maybe cold, a cough, that is a general cough. Then I also take into consideration things like anemia, because this is likely to develop as a result of the lead emissions that take place from the mining activities. So there might be an increase in anemia cases because of the emission of lead from the mining activities. Then there's also the aspect of chest infections, which are likely to occur, and very, I think in high percentages because of the emission of sulfuric acid that takes place during the production or even during the processing of the metal ores. Then the other aspect is the diarrhea levels, which are likely to take place because of the emissions and of effluents that go into any water streams that are being used even for the production of water to the population. So in case of the copper boom, like I said, this began in 2003, and I focus on the impact of copper production, and the period, like I said, was between 1996 and 2010. Because of the potential problem of endogeneity, I tend to use instrumental variable estimation, with the first stage being represented by the copper production. And the instrument that I used in this case is the international copper price, which I believe there is probably a relationship, indirect relationship between the copper price and the output, which can only be through the copper production of the mining companies. So in this case, Y represents the measure of health outcomes, and M represents the copper production, that is a natural log of per capita mine level copper production in each constituency. And the last variable, which is the instrumental variable, represents the international copper price. Finally, we look at the control variables represented by XCT, which is just a vector over the control variables that have been alluded to in the previous slides. So in terms of results, you find that there's an increase in diarrhea cases in constituencies close to the mines, and this is at a higher level than those far away from the mines. Then there was also a significant decline in general health outcomes. Finally, the health outcomes are dependent on the mine type. So comparatively, there was poor health outcomes with the presence of underground mines. And lastly, I brought in some robustness checks, which try to look at the real incomes as well and how these are going to actually impact on health outcomes. And these actually showed that there's a significant impact of health outcomes on of real incomes on health outcomes. So if you look at the results, I think this can be clearly shown from our main variable, which is the natural log of per capita mine level output, which just shows a negative relationship between the general sickness and the mine level copper output, which represents the pollution, and also a negative relationship with anemia. In terms of chest infections, there's an increase in both chest infections and diarrhea cases as a result of an increase in copper production, which ultimately led to an increase in pollution levels. Then on the other hand, in terms of mine type, we find that the impact is much higher and significant when dealing with underground mines in comparison to the open pit mines. In terms of the robustness checks, I'm
afraid they have to stop you because you went way above the allocated time. What I suggest, since your paper is online, so people will be able to read it, what I suggest is I'm going to give you 1 more minute, so you choose either to continue on the results or go straight to your recommendation.
Let me just go straight to the conclusion, Hannah. Thank you so much. Okay, so I'll just run through the conclusion quickly. The robustness test can be seen from the presentation on the app that is provided. So in conclusion, like I said, I focus on the within country variation, which might have been externally valid as international copper price was used as an instrument for mine level copper output. And you find strong evidence that there's a pure effect of increased pollution and health outcomes, which vary significantly by health outcome and mine type. And you also find strong evidence of a link with real incomes and rural and urban status. So depending on whether a constituency was a rural constituency or an urban constituency, there's actually strong evidence of a strong link between the real incomes and the status of that particular constituency. And this paper finally contributed to existing literature and the current debate on nature resources and health outcome by showing the presence of reverse causality between nature resources and health outcomes. In terms of policy implications, this helps towards policies to promote safe mining and improve health, and also may assist governments to design interventions to target priority areas and also focus more on how to control the levels of pollution in nature resource extraction. Thank you very much for your time. I don't know if there are any questions or they'll come afterwards. Thank you for your time, Hannah. Thank you so much, Mina. I think I'm through with the presentation.
Okay, thank you. So I think everybody is here in terms of discussion. So we are going to start with Boniface for his discussion of the first paper that was presented today.
Okay, Shukrani Mina. The paper was well written, and then I learned a lot while reading the paper because I'm from SADC region and Commerce region, both of them. So I was more interested in reading the paper because of that, even though I received the paper, 2 days ago. I have some suggestions. First of all, my suggestion is more on methodology, especially econometrics part. They use a growth model with adding other component of a trade. But I think we have some potential omitted of bias that should be solved in the model. Because if you use the literature of international trade, we have many potential omitted of bias that can lead to endogeneity. And but the author, by choosing use pool OLS, that I think is more limited to deal with a panel. And I suggest that they can try to look, like a fixed effect model, and especially I want them to use dynamic panel because there's a growth. I think initial growth should be controlled. That would be it will improve better the efficiency of the parameters. That one of my proposal. And the second one is that I think the paper should try to look at, because the service definitions, I don't know how they do it, but I didn't find that is more explained in the paper. Maybe we can try to look at, because not all the services that are more relevant, especially when we look at the impact, because we are looking at better growth. So it's not all the services have more impact on the growth. I think we should look at some significance of services that should be, a narrow definition of services that should be used. Because when we know 90% inter-Africa trade, I don't know if we should count on, with impact. So I think we should narrow the definition of services that should have a bigger impact on the growth. That was my comment and proposition, for the authors. Thank you.
think you are muted. You are muted, please.
Okay. You can see me talk, but you can't hear, right? Okay, so thank you, Boniface. And I think these are the two comments that I had also on this paper, and I completely agree with your comments. And this, for the second comment, which is about what type of services are being used, that's extremely important because you're looking at SADC, right? And if you have been to Africa, Sub-Saharan Africa, and most of us have been, right? You see that there is one giant provider of services to other countries, which is South Africa, for certain type of services. For example, for financial insurance and retail and even telecommunications, South Africa is huge in the other countries. So, so knowing what sectors or what subsectors are included is very important and would enrich the paper. I am going to give the author or one of the authors a chance to respond to the comments, and then we'll, no, excuse me. Let's take more comments on this paper, then we'll give the author or some of the authors the chance to respond, and then we'll go to the second paper. So does anyone else from the attendees have any questions or comments? Any questions or comments on this first paper? I guess not. So let's hear from the author or the authors on the comments. 2 minutes.
Okay, thank you very much, Amina, and thank you very much, Boniface, for your comments. Actually, we didn't specify a growth model. We looked at the level of services trade. And because all the services components are interwoven, we chose to use the overall services trade components for this particular study. Because trying to diffuse travel services, banking services, and every other connotation of services was actually a bit lopsided, because each mode is actually linked to another mode. So I think the best thing was for us to use the bulk components of services trade to actually see how regional integration can propel more services trade in Africa using COMESA and SADC. And to your observation for fixed effects and dynamic analysis, yes, we can look at that, we may explore it, only that for the visa openness index, if we are to use a fixed effects analysis, so many countries will be omitted. So the pooled analysis was able to actually infuse all the countries in SADC and COMESA all together, because we only have 3-year observations from the African Development Bank. So I don't see how having a dynamic analysis may work in this case, but we will definitely explore it. So we'll look at fixed effects and dynamic analysis as you have suggested, and we'll see how it goes. Thank you very much. We deeply appreciate your comments.
Okay,
thank you very much, Ngozi.
Thank you.
Mina.
Yes.
And Boniface, thank you. Just to add to the response from my colleague, initially we actually had using the four modes of services trades. So we had that analysis earlier, financial services, commercial services, all of that. But the result was not like it shows the number of countries with that complete data and that.
Yeah.
So that's really what our major concern. But the other fixed effects we can explore that. But when we try to balkanize the services trade to different modes of services trade, the 4 modes, we had such a data challenge. So that's basically the comment I want to add to that. But once again, the comments actually want to we see how we can look into it and how we can handle it as we move on. Thank you so much for the observation and comments. It's appreciated.
You are welcome.
You're welcome. Okay, so Ben, I see Ben is here, right? So Ben is commenting on the second paper. Go ahead.
Okay, yes, I'm here. I like Dr. Yemba's. I'm coming with a comparative disadvantage because I didn't have a chance to see the paper, but I tried to do my best in order to provide some comment based on the actual exposition of the paper and some questions I may have with respect to the political and economic development in Africa. I would like, first of all, to provide a positive feedback. The paper, as presented, as I saw the result, is very interesting topic about the financing of development of Africa. At the same time, the authors went to different models where they tried to address every single question. For example, using the fixed effect time effect panel, they use also Blinder, Hawaka decomposition, and so on and so forth. That is very interesting. But one element I have to note is about the sample size. I saw in some tables, we have 17, 15, 12 African countries. And the question is, on the policy side, it will be a hard sell. If you want to do wholesale public policy using 17 countries and to make a statement that is going to broadcast for the entire continent, that will be a challenge there. I don't know if they are going to address that issue later on. My understanding is about the data limitation because the source coming from Bloomberg, maybe the other agencies that are providing the data, but it should be justified. Even the title should change, because if you are talking about Africa, Africa, because somebody may have an idea about 54, 55 countries based on the division of Africa. That is something to consider in there. Now, I don't know, because I didn't have the layout of the paper to see the effort of integrating different models, because I see the history of the Blinder, how our decomposition is coming from the labor markets. They try to address issue with respect to discrimination based on gender, based on ethnicity, and so on and so forth. I don't know the same history, the same application, how well it can fit in the financial markets or debt markets. I have no idea, but it may be a good exploration. But at the same time, the author should make effort in explaining the processes, how well they can be able to come to show discrimination. And the definition of discrimination should be very specific, because we are in social sciences. Sociologists or my friend in political science, they may understand differently discrimination compared to what is presented in the paper. The author should be able to address this issue as maybe in the next cycle. Now, in terms of questions, I want to reflect back, and I believe Henan and Emma, they are aware of Dombisa Moyo's book about the debt aid, why aid is not working, and how there is a better way for Africa. I don't know if they had a chance to explore some of the claims coming from that book, because my understanding is that, and then reading back, I kind of go to the historical perspective, the fortunes of Africa, 5,000 years of history of wealth, greed, and endeavor. In many countries, take the case of Nigeria with a lot of oil, take the case of the Congo, take the case of Botswana. We have some countries, they don't need any financial aid to see if they can be able to monetize the natural resources. But maybe the discussion can be a little bit different. But my call is that, is it possible when you want to present your policy recommendations to connect to some of those questions asked by other authors, including Dobisa Mo's African from Zambia, who still has some concerns. That is some of the note I made as I was reading the paper, and I hope you had a chance to see the actual paper. I could contribute more, and I'm kind of very limited because I didn't see the actual paper, but I was going on the fly based on the actual exposition and taking notes here and there. Okay. Let me see if I have anything else maybe before I yield back to Amina. Maybe the last question is about the statistical inference. Again, we have 17 countries. We have some, because if I get well, the epistemology behind the econometric aspect of it is we have two groups. We have group A, maybe the treatments. We have 17 countries, and we have other comparison groups. It may be some countries in Latin America, Eastern Europe, and so on and so forth. Now, the question is about the statistical inference. I don't know if Anna or the other colleague can be able to address the issue of statistical inference or its limitations. Thank you.
Thank you, Ben. So would any of the authors of this paper would like to address this or reply?
Sure. I don't know if there are any other questions from the attendees that we need to take as well.
Yeah, you're right. No, you're right. Okay, anybody else from the attendees with questions? I forgot that part, sorry.
Yeah, Mina, thank you. One is to the chair. There was a comment from Christian. The attendees they can't talk. They can only use, I don't know how that can be handled. So that's one comment from Christian. He sent it actually on the chat. Just Mina, Anna, I have a short question. The issue of borrowing for unproductive, or what some have called unproductive borrowing, that we've seen across many African countries. Okay, for example, many countries in Africa, when there was a crash at the global market of their commodities, what was expected was to cut down on expenditure, but what they did was to keep expenditure high and also increase borrowing. So borrowing increased, and most of those borrowing actually we're not very clear about the productivity of such borrowing. So how do we handle this issue that will not go back to the SAP era where most African countries have a debt overhang? So what is your recommendation in that perspective? Thank you.
I also have a question, Mina.
Yes, go ahead.
Oh, yeah. So for me, that's, very good question, but, what I'm seeing is that, as Ben just said about finance in Africa, is that I don't know what the ABD is doing, to help many African countries to develop some financial markets, especially the secondary markets. Maybe that would be a venue, a solution to many of problems we have in Africa. Because when you borrow money in another case, especially the euro bonds, and then you have all the volatility of exchange rate most of the time and interest rate. That just what the bank is doing to help those African countries to develop those financial markets, especially the secondary markets.
Thank you. Anyone else?
Oh, maybe Ben again, if I want to go back, I didn't want to put on the hard part of the Africa Development Bank, but as you as a researcher, at the same time as African and somebody connected to the bank, for me, you have to be able to see why the rest of the world is pricing high or is penalizing Africa. That is part of the history. But the question, as Boniface was asking, what the African Development Bank is doing in order to assist the financing of Africa. And then another question is kind of political question, is not directed to you. I'm asking to all Africans. We are here as scholars and Africans and so on and so forth. And the people working in Africa as a field of study about the political leaders, because some of those resources we have there, we can be able to monetize. Why not is that the case? Okay, I do want to go back to Martin Murray, the book, The Fortunes of Africa. that is something we have to be able to consider as we go forward. Thank you.
Okay, thank you. Go ahead, Iman. I think we're gonna, Hanan, sorry, we're
Yeah.
gonna run out of time.
Sure. So let me thank you very much, everyone, for your comments. Let me clarify a very important point. I think maybe I should have been more specific in the beginning of the presentation about it. This is examining countries that have issued Euro bonds, so markets that are able to tap international capital markets. Remember, the total number of countries that have done this in the last, decade is around 18 African countries. So the fact that we are actually capturing 17 of them is in itself an achievement. And here we are only looking at those that we're able to capture, a 10-year bond yield across the time period that we're looking at. So that's why we have these numbers. So we cannot have more numbers because basically we don't have more countries that are able to tap international capital markets. So the idea here is, okay, for those that are able to tap international capital markets, why are we seeing them being more penalized or discriminated in terms of pricing for the same set of fundamentals? So if you have, countries with the same fundamentals in Latin America, why are the African ones, paying a higher premium? That's the question. And hence also maybe that's another thing that we need to be clearer about is like the exact definition of what we mean by discrimination. What we mean is if you have the same characteristics as a country and you're going to the capital market controlling for that, you should be treated similar to other countries that are tapping the international capital markets, regardless from what region they are, without the need for you, being an African country, to pay a premium to be able to get the financing. So that's also, I think, something that we maybe just for even general readers to be able to elaborate a little bit more on what we mean by the discrimination. In terms of the issue of combination of models, this is coming, it's kind of the intersection of finance and economics. So a lot of it is, some are coming from, voluminous finance literature and capital market asset pricing models that have been developed and so on. So part of it is drawn from that to establish the herding. And the other is really drawn from the economic literature, which has also been evolving to capture not only the typical macro-based models, but increasingly we have this using of Oaxaca decomposition and so on to almost do type of experiments to understand this differentiation or discrimination across different groups. So that's why we ended up using these different models. I think, some points are made. I think they're related, but we cannot infer a lot from it based on the data. For example, the issue of the aid. The fact that African countries need to be a lot more prudent in tapping international capital markets because sentiment can turn against them quicker and they can have even higher cost of these market changes and market sentiment means that they need to think twice before using that, meaning that, if there are other things that are, whether it's more concessional funding, whether it's from multilateral development banks or aid or other sources of financing, that would be, the best to go with first, rather than to tap international capital markets, because even though for whatever global conditions, it can be accessed with no conditionality at a lower rate, but markets can turn quickly against the borrowers with changes in global environment. So these are the type of things I'm happy to go into more, but these are really the issues. And of course, things like developing local capital markets is key, and things like secondary capital markets and like Boniface was just saying are very important also implications. It's not directly related, but I think one of the things that we can perhaps highlight in the recommendations.
Thank you, Hanan. Thank you. Iman is commenting on the third paper, and I think we have only like 6 minutes left. So Iman, if you could limit it to 2 minutes, 2 to 3 minutes, please. Is Iman there? I guess
I
not.
don't think so. I cannot see Iman here. I don't think so.
Okay, it's a she. I think it's a she. Iman in
I'm
Arabic.
sorry, she's not here.
Okay, so what I would like to do is ask the audience if they have any questions about the third paper or comments.
Mina, I believe they can write if there's some they want to kind of write questions, and then you can be able to see them and read if they, because they don't have credentials to speak, but they can write. They can send a question, written questions to you or to the chat. Yes.
But
Yeah,
nobody-
they can participate in the Q&A, I think.
Yes. Yes.
Yeah.
They can. Mhm.
Okay, so let's go to Q&A and see if we have anything. No, it's not showing me anything. What am I doing wrong? This is Q&A. Answers, okay, open, answer 3. There is nothing, no open questions. Okay, so there is no open questions. So the discussant for the last paper, which is the paper on the copper industry in Zambia, and that's Evans, right?
Yes, Mina.
Okay, all yours.
Okay, how many minutes do I have, Ma? How much do I have? Okay.
2 minutes or so.
2 minutes. Okay,
No,
thank you.
3 or 4 if nobody else is asking questions. I think just because
Okay.
we want to give the author the opportunity to reply. So please make it like.
It's okay. Actually, I have them written down, so I can actually send it to her after now. But you also go to main issues. I won't bother with others for time's sake. First and foremost, I want to appreciate Chumba for the depth of analysis in the paper, and it's quite eye-opening, particularly looking at the case of Zambia and seeing how copper mining could affect household health status or health outcome, which is quite very helpful, very important. One clarification I want to make first is in the background, we are given the data coverage, but in the main session I had to do with data, such information was not actually there. So it will be very helpful to provide such information on the data right there on the data session. What I could see was she used LCS living conditions monitoring surveys. But I wanted to see the productivity of the data would have been also very helpful to provide right there at the data session. Another thing to show is that in the analysis table results, particularly table 1, there was effort to look at the variables in terms of the proportion, but a number of the variables we couldn't look at the unit of measurement, so we didn't know the. And of course, I could imagine that age is in years, but the other variables like capital mining of copper production. So it's better to put the unit of such measurements, so it will be good for the readers to appreciate that. Then also the issue of a threshold. She used, I think he made argument using 200 kilometer radius. I was saying, okay, from the literature, the recommendation is between 40 and 200 kilometer. So I'm asking myself, if we would have used a lower threshold, like 100 kilometer, what will be the kind of result we also get? And this is also very important if you understand the RODD, regression discontinuity, that 199.5 and 200.5 are very close. But want to see how such, if we use lower bound or lower threshold, do you have the similar results? So it's very good to have such a discussion in the paper. Another area I would also love to see is the issue of local institutions. What role do local institutions play in this kind of analysis? Because it's not out of play. I've seen that in a number of countries that have resources that, even though the central authority controls such resources, but the local institutions, local authority also have a role to play in terms of the bargaining power of the returns to such a resource revenue or benefit of such resource from that the resources in their areas. I've seen that analysis. So I would love to see a discussion around the role of local institutions in this kind of analysis, particularly issue of compensating for environmental damage or for pollution caused by these mining activities. So that's one area. The other point I want to quickly bring out is in table 6. I see. I was surprised to see poverty in the result. Where the result, where the model was discussed, I couldn't see the poverty as a variable, as a measure discussed there. Neither did I see the cutoff. What unit of measurement do what poverty measure are we using? Are we using 1.0, $1.9 per as a non-poor or poor? So there's need to have such clarification in that. Then lastly, the issue of in the conclusion and recommendation, I would have seen, because in your result in table 3 and result in table 4, you're able to bring out a very wonderful dichotomy between open pit versus underground mining. And from that, we could see difference in result in terms of significant and also in terms of magnitude, similar to when you have a rural urban dichotomy. But in your conclusion, I would have loved to see such a recommendation. Which one are we saying the open pit will be much more instead of hectares? So there's such a discussion would have been better to put in the recommendation. Once again, I enjoyed reading the paper, and I have other comments, but I can send that to you by email since we have an email exchange. Thank you so much. Thank you, Mina.
Thank you, Evans. And I have a question from Christian, which is, he says that the production levels went up and the trend in production of copper and the trend changed in 2000. Is there an explication for this? And I'm gonna give Chamba time to answer this. And I'm hoping that the ASSA are not gonna just shut down this on us because we're beyond 2 o'clock.
Okay, thank you so much, Mina and Eric, for the comments. I've taken note of some of the comments. I think I'll wait for your detailed comments, Eric, from the email. But in terms of, I think, compensation on the damage that is being caused by pollution, I think, sorry, Evans, in terms of compensation, I think all the management of whether pollution or anything that is happening is centrally run. I think I mentioned that in the literature as well, even as I explained on the justification of using government expenditure as a control variable. And I deliberately had to put that to take care of that aspect of the compensation as well. Then for the other comments, I think I've taken notes of them, I'll look at them. Then I think the last question from Christian, sorry. Can you just repeat the question, Mina? Sorry, didn't get that.
Yes, he said the production of copper went up and the trend in production changed in 2000. Is there an explication for that, for the surge and the change in the trend?
Okay, I think I explained that in the presentation partly, probably it was missed out. Even in the paper, it's indicated that I think from around 2000, there was privatization of most of the mines, and the mines that had stopped producing previously were being reinvested into a new mines were being opened. So there was probably an increase because of the increase in the number of producing mines and reinvestment into other mines as well. Let's say increase in the production of the copper. I don't know if that answers the question.
I don't know, because Christian can only write the question. He cannot talk.
Oh, can't talk, okay.
So awkward, yeah, because people cannot. Anyway, I would suppose there is also the China effect there, no?
The China effect comes into the reinvestment as well, because partly they're the ones who have been reinvesting into the new mines as well.
Yeah, and there was a huge surge in the buying copper for China in the 2000s, early 2000s.
Yeah, from 2000 upwards, there's been an increase in buying of copper from the Chinese market. I think it says it got up to 215, so you should be on time. It got up to 215.
Yeah, this is good. This is actually, and I think that doing it on Zoom, maybe we can keep going without anybody stopping us. Anybody who has seen me talk at conferences, they know I like to keep talking. Anyway, so anyone else with any comments?
Yes, I have a comment. We still have like for 11 minutes.
Oh,
Yes.
it's 2:30. I don't know what, I'm so
Yeah, we're
sorry.
15.
I'm
Yeah,
on
we still
sabbatical.
have.
Okay, so I was on sabbatical, so I'm out of the loop for so many
Okay.
things. I'm just slowly going back. I'm so sorry. Hanan, you can go back and talk all you want.
Yes. Yeah, I have a question to Chomba. No, kind of question at the same time a suggestion with respect to research. My point is about the general sickness. I believe, Chomba, if you can be able to deconstruct your general sickness, and I don't know if it is possible for you to go to that level of detail in analysis, so that we can be able to see inside the general sickness which one, for example, is more affected by the mining, because general sickness is kind of broad concept, and I believe if you can go down deconstruct, it will be very interesting, especially for the kind of discussion or analysis of the result, even in terms of policy aspect. It will be very interesting because if there is any policy to put in place, general sickness can be very difficult concept to deal with, but if you can pinpoint precisely which kind of sickness, then we can see in terms of public health what action the government or the local, the federal government or the state government can be able to come in. Okay.
Yeah.
You're right. The second one is about the idea of, I believe Evans was making that note about the radius or the cover or the geography, the kind of geographical impact of the mining. If it will be possible for you to zero in, for example, because you are measuring in terms of kilometers, but if you are measuring in terms of miles, 1 mile radius, 1 kilometer radius, 2, and so on and so forth, or half, quarter, or mile, and so on and so forth, so that you may be able to see another picture in there. Because I speak as somebody who does spatial analysis. This is we call ecological fallacy. If you go zero in very close to the mine, let's say quarter of a mile, or maybe kind of within the proximity of the mining activity itself, you may be some effect. As you go out from that point, you may see the effect maybe declining. I don't know if it be something you may consider second paper or an extension of what you do as of now. The last one, maybe I want to just shut down. The last one is about malnutrition. In many places, you see, I'm from the Congo. We are neighbors. We have a lot of minerals. We have the same issues. Uh, Malnutrition is very prevalent in the mining area because everybody is involved in mining. Agriculture is kind of very small. Did you have any chance to see if you can capture some of the health measures related to nutrition, for example, body mass index, and also malnutrition on the young? You see, that would be something. It would be very impressive, Chomba, if you go to the route. And I believe it's going to be interesting. And before and after privatization of the mining, you may be able to see also, do we see any difference in terms of health outcomes? Okay, that's some of the notes I had for you. Thank you. Thank you.
Okay. Thank you so much, Ben, for your comments as well. Take note of those suggestions. Thank you so much.
Thank you.
Yes, to just follow up on Ben's first point regarding like picking certain diseases, you may want to look at infectious diseases, especially that in your, when you were talking about this, you said like there are problems, respiratory problems and things like that that might occur, which we know with mining demand. And you may want to look at that. Right now, I think Zambia has just like 20,000 people who got affected by COVID-19, and I hope it doesn't increase beyond that. But it might be interesting if you can get even data like information from hospitals or things like that about people living in that region where there is more concentration of copper production, if they have higher level there than in other parts of Zambia.
Okay, that's a very interesting point. Thanks, Mina, as well. I should take note of that.
So I am going, because really I had to cut Hanan off a little bit short, and I am going back to ask Hanan if she has any other elaborations about addressing those comments that were made on her paper.
Thank you very much. Let me let me look here. Yeah, I think that one other thing, I mean, it hasn't been done in the literature, but maybe from the comments that were mentioned is maybe something worth looking into is the issue of the pricing or discrimination and the relationship to commodity cycles. Because that would, would make sense that there may be like, discrimination that is based on the either what is going now or what is expected in terms of futures for certain commodities. So this could be something that we can reflect into incorporating either in the main specification or as some of the robustness checks that we are doing. I think that was the main one that I haven't really had the chance to comment. But lastly, about the issue of making reference, using it to basically draw conclusion or recommendation. It's really, we can, but it's really focused on those that have been accessing international capital markets. So that's the bottom line. Thanks very much.
You're welcome. Anybody else at least from those who can speak?
Oh, Ben again, I don't know if I can.
Go ahead, Ben.
Oh, Evans, go ahead, Evans.
Yes, there was a question not to Anna, but to talk as Africans, what AFDB is doing regarding to have a kind of a capital, financial capital for a kind of capital resource pool for African countries. And that was a question that was raised for us to discuss as Africans, not to Mina as AFDB staff. But basically, I can say they are doing a lot, but I won't expect much because if you look at the AFDB voting rights, if you look at the top 10 countries in terms of voting rights, you'll be surprised that 5 out of 10 are not in Africa. You have the US, you have Germany, you have Canada, you have Japan, you have France. So if you have more than half of the top 10 voting countries that have voting rights outside Africa, so how can we expect AFDB to be African in nature? So these are issues we can discuss as African scholars. Thank you. Just will throw that open for that discussion. Thank you so much.
Okay, this is better again. We have about 3 minutes.
Okay, so yeah, go ahead.
Oh, and because you have the home advantage, and as I can see, the geographic representation of your 17 countries, maybe another paper you may be able to think about maybe for the next meetings or and so on and so forth. See, what are the issues the countries are facing, not be able to be among the 17? And that may be another very interesting question, because you have access to the data, you can be able to come maybe talk to us, or maybe another format we can be able to continue the discussion on. Okay, thank you.
So no question for us.
Oh, okay. Oh, okay.
Yeah, go ahead. Go ahead, Ben. You have questions for them?
Yes, because the idea about the model of we have 3 countries and so on. So the rise of China, how do you see it, Dr. Yepa, with respect to your paper?
I think, well, I see the rise of China is more, because what they can say, China controls today, that is honest, all the natural resources, in many, you can look at, Congo, Zambia. So the 2 copper reserve in the world in Africa is under China hands. So they have everything. And this cycle is not good impact in Africa, because if we can look at our budget constraint we are discussing, the profit is only for 2 sectors that we have in the paper: trading sector and not traded goods. And those small add values. So if you expect country to grow with kind of, a situation, I think, we have to change completely. That's what we propose at the end. The ownership of capital, especially in the mining sector or oil sector, should be African. That's the only way that, we can have all the spillover effect in terms of impact on local financial markets, and also to produce billionaires in Africa. That's the only way we can do it. Because Dangote, other guys, they are not many, but if you count other billionaires, so let's give an example of Congo. Our mining sector is being controlled for a long time by Kabila and the Israeli guy. So everything, even the royalties, are being paid to them. So what the government is getting is zero. So it will be a partner now we are seeing, everywhere in Africa. Zambia, the same thing. China is controlling everything. So that's what.
Thank
But
you. Nina,
Nina,
you have to take control. Okay.
Yeah,
It will be cut off quickly.
I think
Nina, you
we're
have
gonna
to
get
go ahead.
cut off. Okay, so